Okay, so now we're going to talk about a subject that's really important to property investors, but sometimes perhaps neglected by many investors, and that's the subject of depreciation and its importance to the bottom line for investors in residential real estate. Our special guest today is Peter Folds from Washington Brown. Hello, Peter. How are you doing?
Doing very well, thank you, Terry. Hi to everyone. Thank you very much for having me. It's a pleasure to be able to take up some of your time and tell you a bit more about property tax depreciation.
Okay, perhaps you could start by just telling us a little bit about Washington Brown, who you are and what you do.
Sure. I'm here tonight representing Washington Brown Depreciation. I've been with the company for over a decade. We are quantity surveyors that specialise in the preparation of tax depreciation schedules. Of course, all of your subscribers, Terry, would be aware of depreciation. Being a means of reducing your taxable income. So it's a legal tax deduction available to property investors. When you're renting out a property and drawing a taxable income off that, of the rental income, you're able to claim a deduction based on essentially the wear and tear of the building itself and the items within. And that's what tax depreciation is, the ability to claim that wear and tear.
But is it fair to say that some investors at least just aren't fully aware of the importance and how much difference it can make to the success of their investment properties?
Sure, absolutely. I think that's a very fair and accurate statement, Terry. In my time here, and certainly the team here are constantly surprised at the number of investors that we encounter that don't know about tax depreciation. You mentioned, do I think it's a lack of appreciation to do with that? I do, but I don't think that's deliberate, Terry. I truly believe that it's a case of not knowing about tax depreciation.
Yeah.
It's certainly not something we're taught at school, or certainly not at the school I went to, or perhaps I was sick that day. So I think once a property investor knows about depreciation, knows the benefits, understands how it helps them reduce their taxable income, the appreciation goes up. So I think it's just a case of not being aware of the benefits.
Yeah. I know that every situation is different, but is it possible to quantify, perhaps in some simple case studies, just how much of a difference it can make for a property investor?
Yeah, sure. Look, I think I've scribbled some notes here, Terry, because I wanted to be able to give you a sort of some figures like this. So look, for a new built house on the outer fringe of the Melbourne metropolitan area, with a build cost of around $280, an investor of that, as long as the property has been available for income generating purposes from completion, and I'll come back to that point in a sec, you might be looking at a first year deduction of around $14,000 in reduction in your taxable income, and that's in the first year alone. To give an example on the other end of the age spectrum, so that was for a new house. Terry, a house built in 1970s, purchased this year. This was for a client recently that we did the report for. Even though that property is really, really old and affected by recent legislation changes, that house is likely had, in this particular instance, had a bathroom renovation, had an awning done out the back, had a new kitchen put in some time ago. We thought maybe 15 years ago. They're still looking at a $2,000 deduction, tax depreciation deduction each year for the next 15 to 20 years. So still very much worthwhile.
So you're speaking there to an element that maybe a lot of investors do overlook, even when they have an old property. If they inject new elements to the house, do some renovations, that starts to make an older house more qualifiable for claiming of tax deductions through depreciation.
Yeah, absolutely. And Terry, if I can mention, in May of 2017, there were significant legislation changes announced as part of the federal budget address, and they really sort of hit tax depreciation legislation very hard. Essentially, what they've said is that of the two components we look at when we're assessing depreciation deductions, being the structure, so the building itself, and then the plants and equipment items, things like the carpet and the ovens. In this legislation change, they said, look, if you purchase a second-hand property after Tuesday, May 9th, 2017, you're no longer eligible to claim depreciation on that plant and equipment component. What that's led to in the industry, Terry, is sort of people picking bits out of the media, or perhaps media not reporting so accurately on this. And there's this sort of misconception now that, okay, I bought a second-hand property or an older property, there's no point getting a depreciation schedule, or there's no benefit. When in fact, yeah, if a previous owner has made structural or improvements of a structural nature, or that have a structural component, like I said with a kitchen, if a previous owner has improved the kitchen, the new owner won't be able to claim on the oven or the cooktop or the dishwasher, because that's considered a previously used plant and equipment item. They're very much able to claim on the tiling component or the cabinetry component. So these things add up, and it's always worth asking the question, Terry, where we really try and encourage clients to not just assume, oh, it's old, there's no value in getting a report. We really appreciate being given the opportunity to dive in a little deeper and conduct an assessment to make sure, or at least to see whether there is or is not value in proceeding.
Yeah, so that kind of leads me to the next question. That is, if people aren't sure, is there a capacity for them to just contact your team and just ask, talk about their situation before committing to actually getting a report done, and just get a feel for whether it's worth their while? And quite often it will be perhaps more worth their while than they imagined, and then they can go ahead and actually get the formal report done.
Yeah, absolutely, Terry. That's certainly something we encourage, particularly for your subscribers. So for hotspotting subscribers, hopefully at the end of our chat, Terry, if you're able to display my contact details, my email address, I'm very happy for your subscribers to email me with their specific property circumstances. So typically I'd want to know the address, the year of build, the settlement date, and some other details on a case-by-case basis. Nothing too heavy or that requires too much research or homework on the client's behalf. But that's enough for us to sort of, as I said, take a deeper look at it and give a customized assessment of whether there is any value in proceeding with the report or not. Often there is. I'm frequently hearing stories from the team here about accountants saying to investors, "Oh, look, it's not worth going ahead. Your property was built in the early 80s." Us being able to do that assessment and finding, like in my example, potentially $2,000 or $3,000 a year in tax deductions for the next 10, 15 or 20 years. And whilst that's not an astronomical amount of deductions per year, it's certainly better in, most people would argue that it's better in their pocket than the taxman's.
Yeah. And I think one of the things people perhaps don't appreciate is that you can get a schedule done and it can serve you for many years to come. You don't have to, unless you do perhaps major renovations, you don't have to keep going back and having it updated. You can get one report done, pay a fee, and it can be saving you, even for an older house, many thousands of dollars in tax deductions year after year into the future.
That's a fantastic point, Terry, and one I'm actually a little embarrassed that I didn't bring up. Yeah, you're quite right, Terry. I think that's another misconception in the market. It's that, I'm going to have to get this report done every year. I'm going to have to pay the fee for this report every year, and that's definitely not the case. Certainly, with your Washington Brown depreciation report, our reports are fully comprehensive and, of course, ATO compliant. It means that they'll span the maximum duration, which is up to 40 years. So on a brand new property, you're looking at paying the fee for the report once. That fee is fully tax deductible in itself. And that report outlines all of the tax deductions that you're eligible to claim each financial year for the next 40 years. Now, on an older house, that might only be 20 years worth, but it would still be the maximum that particular client is able to claim for that property. So once again, a one-off expense, a fully tax deductible one. As you mentioned, the only time you would need to address that again is if you were to go and do a substantial renovation at some point.
Yeah. One of the things I like about getting a depreciation schedule from Washington Brown is that it's all laid out for you over the next 20 years or more, and you can actually plan for it because you can see the sort of deductions you're going to get unless something changes for the next couple of decades or longer.
Yeah, absolutely. If you're for savvy investors who are doing their cash flow analysis, it's very helpful to understand what the deductions in future years look like, so that you can sort of assess how much money you've got to play with or to work with.
Yeah, I know we've already touched on this point, but I do want to emphasise that there is a misconception out there that you've got to buy new to get depreciation, particularly since those changes. And as you've said, but perhaps we could elaborate a little bit on it. That's not the case. Second-hand property in many circumstances still have deductions worth having, and particularly in relation to the fee you pay to get the report done, definitely worth doing.
Yeah, sure. So to stress that point, Terry, in May of 2017, those legislation changes were made. They affect one component of the two components we look at when we're assessing depreciation-related deductions on a property. It's true, if you buy a brand new property, as long as that property is available for income generating purposes from settlement or from completion, if it's a new build, you are not affected by these legislation changes. In that scenario, Terry, you're still able to claim full deductions on both the structural component and the plant and equipment component. If you purchase a second-hand property after May 2017, or indeed if you've owned that property beforehand, but it wasn't available for income generating purposes until after June 30 of 2017, you are affected by these legislation changes. That means you cannot claim on the plant and equipment component. You are still eligible to claim on the structural component, provided on the original structure, provided that original structure was built after September 1987. Even if it was built before 1987, it's likely in a property of that age, very, very common that we would see improvements having been done by previous owners. It is the ATO entrusts us with assessing in that situation, assessing what has been improved, when it was improved, and how much it cost when it was improved, when those works were done. And you as the new owner, even though you bought an older property, it's second-hand, it's after that legislation change, you are still entitled to claim on the structural component of that, which is a yearly deduction for 40 years, each year for 40 years after those works were deemed to have been done. So, usually, the vast majority of cases, Terry, the amount of deductions available certainly justify the one-off tax deductible expense of the report itself. And in many cases, they're providing deductions for 10, 15 or 20 years.
Yeah. Now, one of the problems that you have in your industry, and I know we've talked about it many times in the past, is that so many investors leave everything to the last minute. When it comes tax time, there tends to be a bit of a panic, creating a lot of pressure on your industry to generate a lot of reports. I think that's the case, isn't it? That it's very much a last minute thing for far too many investors.
Yeah, it certainly is, Terry, where our industry is highly seasonal in that sense. There's always predictably a mad panic approaching the end of financial year to get the reports done. And it certainly sees a stretch in our resources. I mean, we're used to that and we prepare for that. We're certainly never hit a situation where we're unable to accommodate that last minute rush. But it makes the process a lot more stressful for the investor, just because the timeframes, the turnaround times tend to blow out. I mean, we offer hotspotting subscribers a promotional rate for the majority of the year anytime, but I mean, laws of supply and demand, things are less favorable and less flexible, in that busy rush. So I mean, we would always try and encourage people to think about the depreciation report sort of closer to settlement.
Yeah.
It just, as I said, it's one less thing for the investor to worry about and have to stress about, when it comes to time to lodging the tax.
Is there some, sorry.
No, you're right.
Is there some way that you incentivize people to perhaps do it, at settlement rather than leaving it to tax time to try and smooth the workload?
Yeah, there is. There's sort of various promotions, during our quieter period. I guess I'm taking the sales pitch out of it here by saying that, regardless of the time of year, Terry, we're happy to offer hotspotting clients that preferential price anyway. But yeah, we do try and manage that or encourage or incentivize not leaving it to the last minute with sort of, pricing and turnaround time incentives. And certainly, with the partners we work with, trying to, to get them to make their clients aware of, hey, this is something you want to get onto sooner rather than later. Rather than leaving it to that last minute rush.
I suspect that one of the other reasons that investors aren't as active in seeking depreciation schedules as they might otherwise be is they think it's a bit of a hassle. They're busy and it's just another thing they have to do. But in my experience, as the investor owner, there's not very much you actually have to do. You guys really do all the work, and all we really need to do is instruct you to go ahead and do it.
Yeah, that's true, and I agree with you, Terry. I think that is a bit of a barrier, or a perceived issue if you're going to engage it. And people are saying, well, is it worth it? If it's going to be that much of a hassle to me, and it's a slightly older property, is it worth it? And the answer is absolutely, it is worth it. And I'm not just saying that because I sell depreciation schedules. It's worth it because we really have designed our processes and the structure to make it as little work as possible on the client. So typical engagement is being contacted. We'll ask a few questions, whether that's phone or email, or via a web link. We'd ask for some basic details on the property. Once we get that back, we'll run a preliminary check just to make sure there is value in proceeding. It's not good for us, and we wouldn't have achieved the award-winning status and the reputation that we've got if we were producing reports and charging for reports that represented no value to our clients. So we'll always run that preliminary assessment. Once we provide a fee, a quote, once that quote is accepted, the client really gets to check out at that point. We'll organise the inspection if it's required. Certainly, if it's a second-hand property, more than likely going to want to go out and inspect. We'll liaise with the property manager and the tenant. Once we've gotten that inspection data, we'll begin compiling that fully comprehensive report, and then we're in touch with the client again as that nears completion to arrange payment. We're always available after the report's been delivered to discuss any points, or items of the report. So it's really, we've really tried to take the stress and largely the involvement out of it for the client.
Okay. Right, Peter, well, thank you for that. Now, as you mentioned earlier, you're actually encouraging people to contact you and with an offer to have a look at their situation and assess it. So we're going to display your contact details, how to really get in contact with yourself, Peter Folds from Washington Brown, and you can have a chat with them if they make that effort and have a look at their situation.
Yeah, very, very happy to do so. Of course, there's absolutely no cost involved in that preliminary assessment. No obligation, even if we do feel it's worthwhile for you, we'd send you a quotation, and there's no cost and no obligation associated with that at all. Just nice to make sure that you're not leaving anything on the table and that you've got the opportunity to claim the maximum deductions or all the deductions you're entitled to. And I'll just mention as well, when you put up my contact details, if there's any other depreciation related questions, also feel free to email them through to me. Very happy to address them too.
Okay. Well, thank you, Peter Folds from Washington Brown, for that was, I think, a very informative in a very short space of time, I think we've made it very clear to investors why it's worth going to a very, very small effort to do something that can make a big, big difference potentially to your bottom line as a property investor. So thank you for your time today.
Thank you very much for the opportunity to convey that information, Terry. To everyone out there, Merry Christmas and a Happy New Year to you too, Terry. Thanks very much for having me.
Okay, you're welcome. Look forward to talking to you again soon, Peter.
Thanks.